Good morning, good afternoon, or good evening, and welcome to the TGI. Thank God it's Friday, the TGI Friday, the 19th of January. Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. Going to go for our usual regular run through in here today. I'm going to look at the calendar, what we've had, what we've got coming up, macroeconomic, geopolitical, fundamental. Factors that are influencing financial markets right here, right now. Plus, take a look at the charts, run through the headlines from the major news wires. So let's start off with, so just below you, I'm trying to plug all this at the moment, guys, get you guys using the resources. We're getting a lot of good feedback on all the resources that we provide here at Trade Day. Just below, if you're watching this streaming live in here, just below the live streaming, you will see 3 boxes in a line, okay, just a couple of tiers down, I think, 1 tile down. So you'll see, I can't go to that page. I can't go to the trading room that you're watching this, if you're watching this live or watching the recording in the members area, because I'm going to get the feedback loop. I'll be here myself talking. So, but what you do see in here is just down there, you'll see the technical analysis reports that go up every day. You'll see our fundamental reports that go up on the weekend, the macro matters and the weekly recap. I'm going to try and add some more macro data into their macroeconomic reports in here, looking at just little reports on the data and what to expect. As we go forward, we're toying with that idea. And then also we've got in here the Live School service, which is actually the daily update on all those macroeconomics anyway. So you've already got it coming in from Live School as well, the US briefing in here. So what we've had in here from the US briefing overnight, you'll see that just below where you are now. So going into today, shock UK retail sales plunge. So UK retail sales worse than expected in here. We had some previous concerning data out of the UK already this week, and this in here is not really interesting us. Unusual alliance pushing back on Feds. El Arian, so one of the leading players in the bond market in here, has been talking about the market overpricing the speed and the depth of Fed rate cuts. He's not looking, the market pricing, as we said previously, up to 6 basis points. Sorry, not 6 rate hikes of 25. 3 cuts. God, I'll get it right in a second. Got to get into my head with cutting rates there. 6 rate cuts of 25 basis points each. And so, look, he says in here, I wouldn't be surprised if we start later, probably beginning of the summer. So the market's pricing in, as we know, we've been looking at repeatedly March. And I wouldn't be surprised if we end up the year with cuts that are closer to what the Fed signaled, which is 75 basis points, as opposed to what the market's price is. The market, as we know, is pricing in more like 150 basis points. We'll come to the Fed tool later on. 150 basis points, that's 25 each meeting starting in March. Whereas the Fed tell us 75 basis points, and they haven't really given an indication of when. And El Arian is saying he believes that it's close to the truth is what the Fed is telling us rather than what the market is pricing in. So obviously, if we move closer to what the Fed are telling us, if we're closer to what El Arian is telling us in here, then that's potentially negative for stocks. But if we're moving towards that 75 basis points because the economy does very, very, very well and stays strong, and we don't need the rate cuts, then potentially that means that equity indices can still perform well. Obviously, this is all longer term stuff, guys. But just wanted to these economic. These webinars in here are trying to give you an understanding of what the bigger picture is, so you can be better informed when we do get data day to day with your day trading. Talking about the day trading, let's have a look at what we do have today. So we've already spoken about this retail sales data out the UK. Second sort of set of data that we've had out the UK this week that's kind of disappointed. And you can see in here a sea of red across the board on these core and headline retail sales data, both on the month-on-month and the year-on-year data. Looking into the day from the US, it's a fairly light calendar in here. Usually in here, existing home sales doesn't do too much. The Michigan consumer sentiment is more likely to be the focus going in there today. It is the preliminary number for January. We're obviously already halfway through January, or just 2/3 of the way through January in here at the moment. So that's going to be could influence markets in the very, very short term. That's at 10 o'clock Eastern. So watching out for that today. On the earnings side in here, going into the earnings calendar, if we look for today, we already have in here, we did a little preview that I flagged to you guys yesterday. Schlumberger, Travelers and Straight Street in here are all, as you can see, beating estimates in here. We've got a sea of green, so better than consensus across the board there. On the calendar as well, Remember, today is the last day for Fed speakers. We go into the blackout period from tomorrow until after the Fed meeting, which is at the end of the month. The Fed meeting on the 30th and 31st, and we get reported to on the 31st from the Fed. So no updates next week, and the first 2 days of the week after. Up until the 31st, we're getting nothing out of the Fed. So today's our last day looking at stuff out of the Fed. Let's take a look at the Bloomberg 5 things to start your day. Now, if anyone new or been relatively new to the webinars in here, if you go to bloomberg.com/markets, I'm sharing the link in the chat right now. Over here on the right side, in here, the most important market news of the day. Pop your email in here and you'll get this 5 things to start your day for your time zone. So there's a US, European and Asian version that are released throughout the day, and they come out in the respective morning, so early in the morning. So I get the European edition. We're going to look at the US edition, but I get the European edition into my inbox, and that comes in around between 6 and 7 a.m. European time. Generally speaking, in here, if we go and take a look at the US edition, it comes out. So my time, it came out basically 1 hour ago. So whichever time zone you're in, you can see in here, it's generally released at 11:30 GMT. So that was just over 1 hour ago, an hour before we start these. So for most of you in the US, you're going to be getting that overnight in here in the very early morning, just before you get up. So this is a good place to start your day. The main thing we're seeing over the last 24 to 48 hours is a strong rally in tech. The NASDAQ 100 is close to close at a record high. Futures positive again in here this morning. 2 reasons in here. TSMC in here, world's Taiwanese chip maker, biggest chip maker in the world, had positive forward guidance. The whole of the semiconductor industry pushed higher. Nvidia notably pushed higher. Apple shares also did well, along the best day for Apple shares since May, and that was on a ratings upgrade in here, despite the negatives that we've had more recently around the Apple Watch. Okay, the Apple Watch being not being sold. Some positives. There was a positive ratings upgrade by, I can't remember who it was actually. JP Morgan rings a bell, but a positive upgrade in here with guidance of maybe Apple rallying 20% this year. Here it is. Bank of America. Sorry, Bank of America. That is. Rating upgrade from Bank of America helped us higher yesterday, and also was the positive launch of the Vision Pro mixed reality headset in here. What else we got in here? We're talking about inversion normalization. Bond traders are increasing against that. The inversion in US Treasury yields is headed towards normalizing. Though how and why this happens will mean volatility will continue. So what does that mean? Well, we've got an inverted yield curve. The yield curve is inverted. Normally yield curve, a positive yield curve, a normal yield curve. If I could quickly show you what a normal yield curve looks like. Basically upward sloping, which means rates are lower in here. There's your normal yield curve in here. This is the normal yield curve, and we go over here. And what we have in here at the moment is an inverted yield curve. So normal is lower yields at the short end maturities, lower yields, higher yields at the longer end. What we've got at the moment is an inverted yield curve, which usually is a pointer towards recession. So we've had that inverted yield curve for over a year now, like a year and a half. It's usually an indication of recession. It looks like we're going to maybe potentially miss recession, okay? Potentially going to miss recession. But the yield curve at the moment is inverted and it's disinverting, okay? So going back towards a normal yield curve. So unsteepening on this inversion, in this version, going back towards here, towards flat, and then going back towards a normal yield curve. So that disinversion, the way that we disinvert is really the important thing in here, and why it's disinverting. Is it disinverting is it a bullish disinversion or a bearish disinversion? Is it coming from the front end or from the back end? Okay. What else do we have in here? Bostic was on the wires yesterday. So I've got the article from Bostic in here. Here it is. Actually, no, that's not the article from Bloomberg. There's also one from Bloomberg in here. So let me just open that one as well. I don't think I've got that one open. But Bostic, we said yesterday, remember we spoke about Bostic being like in the middle, okay, of our Hawk Dove list in here. So here's the Hawk Dove list from trade day. Bostic sits right in the middle between the Hawks and the Doves, okay, and but he's not a voting member, okay, he's significantly not a voting member, but nevertheless giving his views, and what he had to say. Well, basically, Bostic urges caution on rate cuts amid global uncertainty, okay, but looking for evidence inflation is still on track and should allow geopolitical events to unfold before normalizing. Slightly more reporting here from Reuters, a little bit more dovish reporting, open to earlier rate cuts and faster drop in inflation. So if inflation inflation does start to drop, then he's looking for rate cuts to potentially come early. What does he mean by early? Well, probably early is not January. He's more likely talking about rate cuts coming in March, right? So that's, as what the market's pricing in anyway in here. What else? China continued to go lower. The China stock market, having had a rout lower 2 days ago, it was after the macro data we have, GDP data, etc., had another significant set of having had a pause yesterday. And actually, some brokers have started to suspend short selling. Okay, so China are doing particularly negative, but not really having a negative impact on the global stock indices in here. We've spoken about Bostic already. Let's just run through some of the headlines. So US futures continue to push higher, having had that strong rally yesterday. Tech driving, Nasdaq 100 driving higher. We spoke about that yesterday. We had already had the strong rebound. It continued higher in here. And traders are reducing bets on a Federal Reserve rate cut in March, though, and we'll come to that. We've been talking about that anyway, and that's moved even more over the last 12 to 24 hours. Hot chips, so hot chips being hot chip sector in here, TSMC in here, as we have said, been the driver there. TSMC driving the chip sector, the tech sector higher, Apple helping alongside. UK retail sales number, we've spoken about that, and China getting hit again. Futures up, again, this is the same headlines in here from Reuters, different article. Chips, mega caps gain, corporate earnings on tap. And UK retail sales slumps, we've highlighted that. Recession risk there. Oil's doing well now. We've gone back into risk on mode. So risk on, higher demand. And on the supply side, concerns about the ongoing tensions in the Middle East, keeping the oil price pointing to the top side. We've already spoken about El Arian says markets are overpriced. We've already spoken about that. China's biggest broker curbs short selling. Mentioned that already in here. Let's have a run around the markets. As you can see in here, the Hang Seng were down with China again lower in here overnight, despite the Nikkei pushing higher, going to back up to new highs. You can see in here on the Nikkei 225, the Japanese stock index, but the Chinese stock market still doing badly in here. European exchanges doing fairly well this morning, having done well yesterday, up about between 0.2 and 0.5 in here this morning on the European bourses. And if we go and take a look, having had a good day yesterday, S&P up nearly 1%. The Nasdaq was up about 1.5%, I think, yesterday. Nasdaq future up another 0.75% in here on the overnight on the futures. S&P nearly 0.5%, and the Dow up 0.4. Let's run around those. So here's the March. Remember, we've been monitoring this for the chance of a March rate cut. You see now this is up to 45, nearly 45% for no change. Yeah, this was sitting more like this was up as high as for a rate cut was 80, and this was at 20 at one point. If I go in a minute, I'm going to go to the 500 to 525. Actually, we'll go to here to the 525 to 550, the chance of us being unchanged. I'll go take a look at that, okay? But remember, this was up at nearly 80. It's dipped down towards 60 now. In here, we've only got, what's this, 53 point, well, it's obviously the opposite of this. So we've only got a 55% chance in here now of a rate cut and a 45% chance of unchanged now at the March meeting. So backing off that we're going to get that earlier rate cut. We spoke about this, I've been on the TV stations back at the end of December and early January, talking exactly about that would get a pushback originally at the beginning of the year against the kind of ultra dovish position that the market had taken on its expectations from the Fed. Let's have a quick look in here. So you go on this on the Fed Watch tool in here. I'll share the Fed Watch tool for you guys that haven't used it before if you want to go and use it and play with it yourself. But over in here, so that you click on each of the tabs, it shows you what are the chances of a rate cut or the rate moves in here, where rates are going to be each of these. Each one of these dates, by the way, is a meeting, one of the Fed meetings, okay? So if we go to the March meetings, that's got all the focus on the March. We're expecting no change. This is January. In a week and a half's time in here, you can see basically nailed on that rates are going to be at 525, 550. That's where we are now. You can see here, current target rate is 525, 550. 525, 550 is what we're expecting in here for the current target rate in here for January. But if we go to March in here, this has been going up, so the chance of being unchanged, and what we've seen is this has been falling. Okay, the chance of a rate cut. So if we actually go and look at the more recent, we've been looking at the chances of the rate cut. Let's take a look at the chances of it being unchanged in here. So that's the 525, 550 band in March. So over here on the left-hand side, I click on historical, and remember I want 525 to 550. So it shows me all the different options in here, all the different potential columns. Okay, so if I go and unclick all of these, and we want to go to the 525 to 550 left up there. So you can see in here, since the end of November, there's been less, we're all the way up here. We weren't back in November, we weren't expecting a rate cut in March, right? So there was like up here we're at like around 70%, right? 70% chance that rates were going to be where they are in March. We weren't looking for a rate cut. And then we had both positive data and then we got a dovish shift from the Fed in December. And what that meant was then inflation started falling and the Fed then pivoted. This is when the Fed pivoted here and this big drop in here. So we saw less and less chance to the point where we got down here. So we got down to only where are we? It's about a 10% chance of us not of keeping rates unchanged by March. Now we're all the way up here at more like a 40, whatever it was, 41, 42% chance, 45% chance of now rates being unchanged, not the rate cut not coming in March. Down here, we were only at 10% that we're going to stay unchanged. We were 90% certain at one point, really, that we were going to be cutting rates. Now we're at the point of only almost getting close to 50-50, right? 50-50. So it's been a big shift in here so far in January. And that's kind of echoed in the yield curve as well. So you can see US 10-year yields pushing higher. We went to new multi-week highs, not as high yields as we've been. So yields have been falling throughout. As we got that anticipation, let me just pop this out, make this a bit bigger. In here, so this was the anticipation, the same as of better data, inflation falling, and then there's the big push lower in here. That was after the Fed, back in the middle of December. And then so far in January, yields been pushing higher, higher yields, lower prices on bonds, higher yields. And those higher yields in here, they've not actually stopped the equity market going up, but they've stalled the strong rally that we have had in the equity markets. What else do I have for you in here? So just a quick look in here. You can see stocks, there's the bonds continue to go lower. 30 years, 10 years, etc., going lower in price. And we've been talking about that, and they're all looking fairly negative on the market chart. You can get these reports just below where you're watching now. But on the equities, equities have been stuttered. Okay, so January basically seen the market down and then back up again, down and then back up again. So the S&P really since the beginning of the year has been chopping to the side, right? Okay, having had this really strong rally as we saw yields go lower. We saw this strong rally November through December. And then since then, because yields have gone back higher so far this year, equity markets haven't gone necessarily down, okay, but they've been a little bit more cautious. Although the NASDAQ done particularly well, it's back up, as we said in the NASDAQ in here, pushing up and nudging to new highs. So both of the S&P and NASDAQ for me still carrying a positive weight as we go into today. So in here, if we just pop these out, there we see the NASDAQ up close to a high, making new highs in here today. Okay, so looking really bullish Marabuzo candlestick. We were back up here somewhere when we were on the call yesterday, at this time yesterday, and boom, through there and boom, higher again in here this morning. I've got nothing to say about this other than it's bullish, right? How can you not be bullish at this, right, really? Except is it overextended? Well, on this 30-minute chart, not overextended down here on the RSI. Go to look at the daily chart. Is it overbought? Not particularly overbought. It's been much more overbought back here. So it's got lots of scope to still go higher in the short term. S&P is not quite done as well in here, but still kind of rangy, but at the top end of that range. And real risk, I think, that we blast up through the highs in here. So we've got the peaks on the top side to break through in here. This was the CPI data print that we saw last Thursday. That high there, 48.38, and then above there, we've got the high from the end of last year, 48.38 and 48.41.5. I think we have a go to and through that 38.41 area, and maybe extend another 0.5% above there, which is another 20 points through those peaks in here. So maybe up towards 48.60 going into today. That's my outlook. So staying bullish. All right, guys, I'm going to wrap it up there. I'm going to say TGI Friday. Thank God it's Friday. Have a great Friday. Have a great weekend. Have a great trading day today. And I'll be back with you with another Bull versus Bear webinar on Monday. Bye.